Welcome to enrichminds.com and our session on understanding what is a company. In this session, we shall discuss what is a company. We shall learn about the various types of companies and the reasons why one should consider starting a company if you want to engage in any kind of business. So, what is a company? A company is a legal entity formed by a group of individuals to engage in and operate a business enterprise in a commercial or industrial capacity. A company's business line depends on its structure, which can range from a partnership to a proprietorship or even a corporation. Companies may be either public or private. The former issues equity to shareholders on an exchange, while the latter is privately owned and not regulated. A company is generally organized to earn a profit from business activities. Companies are an important contributor to the health of an economy as they employ individuals and attract disposable income to spur growth. A company may also be described as an organized group of persons, incorporated or unincorporated, engaged in an enterprise. How does a company work? A company has many of the same legal rights and responsibilities as a person does, like the ability to enter into contracts, the right to sue or be sued, borrow money, pay taxes, own assets, and hire employees. A company is essentially an artificial person, also known as corporate personhood, in that it is an entity separate from the individuals who own, manage, and support its operations. Companies are generally organized to earn a profit from business activities, though some may be structured as nonprofit charities. Each country has its own hierarchy of company and corporate structures, though with many similarities. Now let's look at the different types of companies you can form. In the United States, tax law, as administered by the Internal Revenue Service, or IRS, and individual states dictate how companies are classified. Examples of company types in the U.S. include the following. First, corporations. Corporations are legal entities that are separate and distinct from their owners and provide the same rights and responsibilities as a person. Second, partnerships. Partnerships are formal arrangements in which two or more parties cooperate to manage and operate a business. Third, associations. Associations are vague and often misunderstood legal entities based on any group of individuals who join together for business, social, or other purposes as a continuing entity. This may or may not be taxable, depending on structure and purposes. Fourth, funds. Funds are businesses engaged in the investing of pooled capital of investors. Fifth, trusts. Trusts are fiduciary arrangements in which a third party holds assets on behalf of beneficiaries. A company may also be described as an organized group of persons, incorporated or unincorporated, engaged in an enterprise. A common confusion occurs when using the terms company and corporation. Are they the same thing? No. There are many differences. In the United States, a company is not necessarily a corporation, though all corporations can be classified as companies via a variety of structures. For example, United States corporate structures include sole proprietorships, general partnerships, limited partnerships, limited liability partnerships, limited liability corporations, S corporations, and C corporations. A corporation is a type of business that is distinct from its owner. This means they require regular tax filings to be submitted separately from the personal taxes of their owners. Corporate ownership is determined by how much stock its shareholders hold. These shareholders may make decisions on how the company is managed, or they may choose a team of directors to do so. The word company is synonymous with the word firm. Some of the most successful corporations in the United States include Amazon, Apple, McDonald's, Microsoft, and Walmart. Now that we know that all corporations are companies, but all companies are not corporations, let's understand the various types of corporations. First, C corporation. A C corporation or C corp is a legal structure for a corporation in which the owners or shareholders are taxed separately from the entity. Second, S corporation. An S corporation or S corp is any business that chooses to pass corporate income, losses, deductions, and credit through shareholders for federal tax purposes, with the benefit of limited liability and relief from double taxation. The major difference is how they are taxed. S corp income flows to stockholders and is taxed on their personal tax returns. Dividends paid to S corp stockholders are not taxable. C corps pay income tax on their corporate tax return. Stockholders must generally pay income tax on any dividends they receive. Third, LLC, or limited liability company. The limited liability company is a corporate structure that protects its owners from being personally pursued for repayment of the company's debts or liabilities. Any entity or individual can be a member of an LLC, with the notable exceptions of banks and insurance companies. LLCs do not pay taxes on their profits directly. Their profits and losses are passed through to members who report them on their individual tax returns. Fourth, partnerships. There are three relatively common partnership types: general partnership, or GP, limited partnership, or LP, and limited liability partnership, or LLP. A fourth, the limited liability limited partnership, or LLLP, is not recognized in all states. There are often distinct reasons why business owners choose each of these partnership types. And fifth, proprietorship. A sole proprietorship, also known as a sole tradership, individual entrepreneurship, or proprietorship, is a type of enterprise owned and run by one person, and in which there is no legal distinction between the owner and the business entity. A sole trader does not necessarily work alone and may employ other people. Companies can be divided into two distinct categories for both legal and regulatory purposes: public and private companies. A public or publicly traded company allows shareholders to be equity owners when they purchase shares through a stock exchange. Someone who owns a large number of shares has a larger stake in the company compared to someone who has a small number of shares. Shares are first issued through an initial public offering, or IPO, before trading begins on a secondary exchange. Public companies are held to strict reporting and regulatory requirements by the United States Securities and Exchange Commission, or SEC. Under these guidelines, companies must file financial statements and reports annually outlining the financial health of the company. This prevents fraudulent reports and activities. Private companies, on the other hand, are held under private ownership. Although they may issue stock and have shareholders, equity in private companies is not traded on an exchange. They vary in shape and size and are not always bound by the strict regulations and reporting requirements to which public companies must adhere. These companies do not have to disclose financial information or outlook to the public, giving them more opportunity to focus on long-term growth rather than quarterly earnings. Private companies have fewer shareholders or owners, and they tend to be actively involved with the business. But public companies have millions of shareholders, and most of them are not even actively involved with the business. Examples of private companies include Koch Industries, candy maker Mars, car rental company Enterprise Holdings, and accounting firm PricewaterhouseCoopers. Apple, Walmart, Coca-Cola, and Netflix are all examples of public companies. Let's now look at the benefits and drawbacks of forming a company. The benefits of starting a company include income diversification, a strong correlation between effort and reward, creative freedom, and flexibility. Another advantage of companies is that they create jobs. If an individual starts a company and it grows, most often they have to hire employees. This increases the number of jobs available in a nation, employs people, reduces unemployment, and brings wealth into the economy. There is often a tremendous amount of personal satisfaction garnered from starting your own company. This involves following your dreams and passions and leaving a legacy. The disadvantages of starting a company include increased financial responsibility, increased legal liability, long hours, health risks due to stress, responsibility for employees and administrative staff, regulations, and tax issues. There is a tremendous amount of risk in starting a company, from the time invested and therefore opportunity cost from not working a salaried job to financial risk. Failure is one of the biggest disadvantages. However, many successful entrepreneurs attest that their first businesses failed and that the experience was an important learning tool. Many of the world's largest personal fortunes have been amassed by people who have started their own companies, like Jeff Bezos, Elon Musk, Bill Gates, and Mark Zuckerberg. Some of the largest companies of the world by market capitalization and annual revenues are listed here. On the left side, you have the 5 biggest companies by market capitalization: Saudi Aramco, Apple, Microsoft, Alphabet, and Amazon. On the right, you have the 5 biggest companies by revenues: Walmart, Amazon, PetroChina, Saudi Aramco, and Apple. Let's now look at a short video on what is a company.
Since the earliest moments in human history, humans have been cooperating and trading to create wealth and gain access to goods and services in various markets. In this fashion, a hunter traded meat for a stone tool, or two farmers exchanged corn for carrots. In short, people conducted business in a personal capacity. As humanity left behind the dark Middle Ages and launched itself into the Industrial Revolution, all sorts of scientific discoveries and technological advances emerged. Wealth generation, up to this point, was a function of how much land you happened to own, and how many poor peasants you could make work the land. New wealth was generated by trade and by entrepreneurial pursuit to invent new technologies, like the steam engine, the rail, the industrial machine. As this transition gained speed through the 1600s, the old concept of business done on one's private capacity became a problem. How would a man, as rich as he might be, take upon himself the liabilities associated with a large-scale rail track laying company, or risk all his fortune by sending trade ships to India to bring the black pepper, also known as the black gold, to Britain, when pirates might bankrupt the whole thing? In short, business became a high-risk, high-investment, and high-return proposition to what used to exist in past agricultural ages. We owe the idea of a company as we know it today to a couple of wig-wearing lords in the British House of Lords and a bootmaker named Solomon. In 1896, these gentlemen brought into being the concept of a fictitious invented identity that could be created by individuals and could get into business and succeed or fail independently from its owners. The new idea soon spread across continental Europe and America and became what we know today. And so came into being a limited liability company, whereby a man would be able to do business through an independent legal identity. The owners would have a right to the assets and rights to the management of the company. When a company had several owners, their relative rights would be determined according to their share of those rights, property, and management. Through the following ages, very little change has been made to these basic principles. Today, there are many types of companies, certainly in different countries, but the same basic concepts remain. 1. A company is incorporated, set up by individuals. 2. Who wish to limit their personal liability and separate and protect their personal assets in case of a lawsuit or claims against their business entity. 3. Who own the company per their individual share of the rights in the company, also known as shares, usually representing how much they invested in the said business. 4. Who then have a right in decision-making and in profit distribution. Types of regulations regarding companies developed during the years in various countries to allow kings and parliaments access to tax revenues by forcing companies to report their income. In some cases, the shares of companies can be traded on specific markets, in which case the company becomes a public company.
In summary then, let's revisit the two main takeaways. First, a company is a legal entity created by an individual or group of individuals to conduct a business enterprise, which is usually the sale of a business or product that is needed or desired by society. Companies have been around for hundreds of years, and there are many different types, depending on the size, scope, and goals of each. Starting a company is a risky endeavor as the chance of failure is high. Even the most successful companies do not last forever if they cannot evolve with the times. But, and second, companies are the primary source of employment in most nations and therefore an important contributor to the economic health of most countries. Thank you for your time. Until next time then, stay enriched and strong.